Big day yesterday. SPY went down about 10 points. As expected, a 10-point move day, but not without first having the 7-point whipsaw. Now, this is tough to trade, right? And this is why we have trading ranges. And this is also why we open straddles. Now, if you still have not seen the video where I talked about taking a trade and never lose here, you can check out the videos here and here. Basically, they're just setups that we prepared for the past 2 days. And you can see how members took it. So congratulations first. When you can survive FOMC and you can make stress-free profits, you know it's always great. Strangles, right? You make good profits here like this. Play puts and calls together, making the profits. Good play. Puts and calls together, making the profits. Puts and calls together, making the profits here, right? So you left your puts open, the puts and calls open, puts and calls, and the straddle strategy, or strangle in this case, worked very well. So congratulations for those who took it. If not, you practiced it and you will understand the mechanics of it. I explained it in yesterday's video. You can see and understand the mechanics of why straddles and strangles will work for days like that, because we were protected by the trading ranges. And you remembered I mentioned 390 and 380. Yeah, these are the trading ranges that we needed to. Now this will be important for the trades later as well, so just keep this in mind still. Let me zoom in on the daily chart here. So remember, unless we cleared 380, which was our end of the trading range here, you do not cut your losing leg. And you notice that in the whipsaw, we bounced off straight at the end of the trading range at orange 380. So having reliable levels really helps us. Understanding trading range really helps us. And you'll notice we didn't break through 390. It's at top of our range as well. So when the chart is within the range, this is a telltale sign that we are still in equilibrium. The market still does not know which direction to go until a clearer outcome, and we had a very clear outcome here at 3 p.m. This was about 3 p.m. here. We can see the time. Now at 3 p.m. what happened? Now I provided analysis for yesterday. Please do check it out, right? First thing at 2 p.m. That's the most important thing, right? But it's impossible to catch this 2 p.m. candle because this was crawled by algorithms. Maybe you can catch it here when we had some retracement, but what happened at 2 p.m. was that there was an indicator, and this was the 4.6% Fed funds rate. So it's the terminal rate. Now this is very important because while we knew it was 75 basis points, and remember when I mentioned 75 basis points, it means the market will whipsaw, and that's what we saw here. But this is more than meets the eye, this 4.6%, and this means that we have, including this 0.75, now we still have 125 basis points left that is not applied for yet, and so we can expect even greater interest rate hikes in the future. So that was the first bearish news that we saw on this Fed funds rate of 4.6%. And that's the thing, right? When the market moves like that, it's very hard for you to make intelligent guesses. And at 3 p.m. here, we talked about how the entire message was bearish at 303 here. Now, many things. First, Powell alluded to an incoming recession. He mentioned how inflation is still high despite supply side recovering, and this was their excuse for the past at least 6 months. And so we knew and needed to give the market some time to digest this news. And so you see, it takes time for the market to digest news like that, even though we knew it was very, very bearish. Now, how do we interpret this technically? As I mentioned, when we have trading ranges, this is an acceptable level for the market. Even if it's a 7-point whipsaw, this is actually acceptable behavior by the market, right? And when we reached near the top and we had Powell summarizing all these negative news, then the market started pushing right down. So yesterday, absolutely no calls. I wouldn't have taken calls here because the first thing I saw was this Fed funds rate. It wasn't good. And the summary of what Powell mentioned up till 3 p.m. yesterday, all bearish news. So we just needed to wait for the market, give it some time to digest itself. As long as it traded within the trading ranges, we knew it was acceptable. So when you have some understanding of the market, it gives you more assurance to trade the FOMC. It helps in many ways. It helps when you have a community that you can turn to get some guidance. It also helps if you have a trade that can never lose, right? So even with this 7 points whipsawing, you don't have to worry. Your puts and calls are covered until you wait for the eventual move. Now, if you cut your puts here, took some profit, rode the way up, cut your calls here, or you cut your calls here and you left your puts open to ride all the way down, they're both very, very good ways to profit. And I spoke about that in yesterday's video. So you can continue to experiment how to trade like this, as long as you understand the mechanics and the logic of this straddle and strangle trade and how these mechanics make it a trade that you can never lose. Now, the next thing is, because we have a 14-day to expiry options, probably left 13 days now, we still can swing it, right? We still can see if our winning leg can continue its way down. But let's talk about this here now. Now for today, here are the few things you need to pay attention to. Firstly, we noticed that 380, now this is the range we were talking about, 380 here. In fact, I want to provide a larger range here between this orange 380 and this yellow 381 here. Now these are in your 5-minute chart. Now when we take a look at it on a daily chart level here, I want you to pay attention to this. Now when I mention 380, it's actually orange 380, right? That's our levels that we were paying attention to. And we have another level here at 390. Now the first thing whenever the market breaks through a new level is to always check and wait for stop hunting. Now what does stop hunting mean? It means that if we manage to engulf back into the 380 range and this 380 turns into some sort of support, then we are having a rejection of the level and we will therefore form an inverse head and shoulder. So that's the first thing you have to look out for. So this level here where we broke yesterday, this is why you have to take partial profits, right? So when we broke through yesterday, we broke through a good 3-4 points. 4 points off our main level, and this is where you have to take your partial profits and protect your puts if you were playing the conservative straddle that I was talking about, right? If not, your puts will actually open here when we straddled at 385, and that would have been a very, very good run here. Now you leave your runners, and your runners will therefore have to be stopped by the time we break through this yellow 381 here. So if we do have an engulfing green candle back into this range and thereby forming a shoulder, inverse head and shoulder pattern here like this is known as a rejection of a new trading range, and we formed a support based on the previous trading range. Now this is a rejection. You have to put your stop losses for your put runners here. So that's the first thing we must always look out for. Now I don't think it's likely, because firstly, if you take a look at yesterday's volume, this was only 100 million on a very red day. The sellers are not even coming in yet. There are more sellers that's for sure. So the question is, will the sellers wait till we revisit some form of resistance before we continue pushing down? And if so, this will also be a very nice resistance level. So today, pay attention to this level here where we broke through. That's the end of the trading range. Orange 380 and yellow 381. And on the daily chart, this level is what you look out for here. Now, if we do form an inverse head and shoulder as we engulf back to this original trading range between 380 and 390, and we should see some flagging again. But otherwise, I would think that instead of forming an inverse head and shoulder for a rejection, we should see some sort of bear flag. So you pay attention to the resistance levels when we talk about bear flags today. Where do the sellers want to sell again and offload their position, especially after so much selling? So that's what we call a bear flag, right? You pay attention to at which level the resistances do we see sellers coming in again to push us down. So that's what we want to pay attention to. The first one is obviously this. Now, this level cannot be reclaimed as the right shoulder, so we have to pay attention to that. Most likely, this will become resistance. So we can always add on our winning positions as well. I talked about this strategy as well at the start of yesterday, right? We talked about this, such as adding on more contracts to the winning leg once a direction is defined, right? This was just before the FOMC. Talked about this just before noontime, right? So if that happens, come across some resistance, hey, why not just add on your winning position if we notice that some form of resistance forming a bear flag. But as always, pay attention to the 5-minute chart. I always use the 5-minute and 1-minute chart to look out for microstructures before taking any trades. Now, the day after FOMC, there will still be big action, right? Still lots of money to be made, so we have to be very careful. Always wait for structures to take trades. So that's the first thing we look out for. Now, the second thing is we are chartering into a new trading range. If this continues to remain as resistance, then we have to identify where is the new trading range that will form the support. Now, this is where having runners will be fun, right? Because basically your runners are trying to detect where that support will be. Now, you notice there will always be some level that becomes some sort of support. There will always be a support that will appear. So we will be looking out for that support. We have some levels here. We have 370, we have 360. So apart from having all these levels, which I've indicated in the 30-minute chart, in the 5-minute chart and 1-minute chart, right? So these are the major levels we pay attention to. Now, apart from these levels as well, because of an absence of existing trading ranges, we have to also pay attention to the bottom Bollinger Band. Now, I've also always mentioned the Bollinger is a fluid indicator. It will continue to shape itself throughout the day. It's not a fixed level, so always pay attention to it on the daily chart as well, as it always shifts. So you pay attention to that. That will sometimes provide a level or a guidance in an area without trading activity for traders to put in their orders, right, based on this, right? So we are human beings, or even algorithms, they need to base it off some sort of levels, and that's where indicators like bottom Bollingers come into play. So pay attention to this as well today, especially when we are still looking out for that support level. So how do we look out for support levels like that? Very simply, micro and macro structures, especially on the 30-minute chart or the 5-minute chart. We want to be looking out for reversal indicators, signs that the sellers have lost strength and we are forming some sort of reversal. So you see yesterday, this is a sign that sellers are not so interested after hours anymore, right? We see selling channels that's tapering, right? And we started to see this. Now, this is not unexpected, but yeah, something like that, right? You see a cup that's forming because sellers are losing strength, and they're not losing strength per se. Because if I'm a seller, I know that the market is bearish. Why do I want to sell here, right? Why don't I just sell at the next resistance? So understand the concept sometimes, right? This doesn't mean that sellers are no longer interested, but this can also mean that the market is extremely bearish. If I'm a seller, I don't have to worry about not being able to sell tomorrow at a higher price, and I can make good profits as well. So let's look out today for that. Quite interesting day after FOMC as always. First thing, always look out for the stop hunt. If these resistances do hold, then we should see a bear flag from there. We may push. Now, the sellers didn't appear as high as I would hope for, only 100 million. So I do think we may have more sellers today. So I'll be looking out for resistances. Maybe continue to play some puts as well, but always look out for stop hunts when we break through new levels. And the next area is to always look out for the supports. Those are very important, as well as the bottom Bollinger Band as well, especially when we are trading without much trading activity. This is a new low in a way since June, I think. New low since July and June, right? So it's been about 2 to 3 months without trading activity here. So we always have to pay attention to possible supports forming, and we identify that by looking at macro and micro structures. Pay attention to bottom Bollinger. Look out for resistances. We may even push down. So let's see how this goes. So it's going to be a great day if you know what to look out for. So thank you very much for watching, and I'll see you closer to opening bell. Thank you very much.